We back. Beautiful day in the neighborhood, another beautiful day to make a video. So last week we talked about the current market conditions, what's causing these high prices, my thoughts on if there will be a real estate market crash. There's some good info on that video. And today we're gonna kinda piggyback off of that, but it's going to be from the rental standpoint. And we're going to talk about the 1% rule. So what is the 1% rule? 1% rule is a good benchmark to use when evaluating a rental property. Simply taking what the property gets in rent and dividing that by the purchase price. And if you get 1% or higher when you divide the rent by the purchase price, it's typically known as a safe investment. And this isn't saying if it doesn't meet 1%, it's a bad investment. That's kind of what we're going to talk about today. This 1% rule was created back in the early 2000s and carried through 08 and 09 when home prices were extremely low and the demand for rent was extremely high because people were losing their homes and they still needed a place to live. Finding a property that met the 1% rule was fairly easy. If you found a $100,000 property and it rented for $1,000 per month, 1% rule says this is a safe investment. But now prices are so freaking high, places might be listed at $250,000. So the 1% rule is saying you need to rent this place for $2,500 a month in order to meet this criteria. And in central Iowa, if you're paying $2,500 per month in rent, come talk to me because you might want to start thinking about buying. So with home prices going up and investment property prices going up, the demand for rent really hasn't been parallel with these prices of properties. And we've been living off this 1% rule forever. But nowadays, it's not really that relevant. There's a study done looking at what that rent to price ratio is today. And the national average came out to 0.51%. So cutting that 1% in half. So we can call it the 0.5% rule. If you can find a property that will rent for higher than 0.5% of the purchase price, you are actually beating the national average. So using this example of the property that's now $250,000, 0.51% of that comes out to a little under $1,300 per month. Anything higher than $1,300 a month, the 0.5% rule says it is a safe investment. And again, this is just a metric to use. It does not mean if you can't rent it for more than $1,300 per month, that it's a bad investment. There are tons of other metrics to look at, but this 0.5% rule, this 1% rule, has just been a common model to use when evaluating a rental property. You also want to look at the break-even point, what kind of tax benefits you can get, tax write-offs, mortgage interest, and the appreciation rate of the particular area you're looking into. And then also you got your cash on cash return, your internal rate of return. There's tons of things to look at. And I have previous videos of this that really deep dive into that stuff if you would like further explanation on these kind of metrics. But to kind of sum this up, if you've been using this 1% rule to find a rental property right now, you've probably really been struggling to find one because the 1% rule is not really that relevant anymore. Price appreciation is not really working parallel with rental demand right now. So instead, look at all these other metrics and use maybe a 0.5 or 0.6%. Anyways, thanks for watching and I will see you guys next week.